How much should we depend on the stock market as per Bill Schantz? The simplest answer to how much you should depend on the stock market is, not a lot. According to Bill Schantz, there is no solid way to determine how a stock will behave in the market because even though the marketplace determines stock prices, the rates remain volatile. However, that is not the only reason. There are other reasons as well that make the stock market quite unpredictable, especially for making investments. Individuals who aim to make long-term investments suffer due to this problem because of the highly unstable nature of the stock market. On the other hand, for short-term investors, the risk does not run that high. They are able to have more control over predicting stock prices, primarily due to spending less time bidding to gain instant returns. Hence, the stock market should not be the only thing to depend upon when it comes to investments. Inflation and deflation. When it comes to stocks, these two terms are important. With rising inflation, the valuation multiple falls down. The valuation multiple helps express the future trends of the stock market. If these trends are low, then the valuation multiple is low. If they are high, so is the valuation multiple. With increasing inflation, this multiple decreases, estimating a drop in the stock market, and when inflation decreases, the opposite happens. Yet, inflation in itself is an uncertain concept. It also depends on various other factors. Hence, it also makes the stock market prices more unpredictable. When it comes to deflation, according to Bill Schantz, it is simply bad for the valuation multiple. Bill Schantz talks about associated markets. Stock prices depend heavily upon the kind of sector they are associated with. According to Bill Schantz, the performance of such sectors affects the stock price. That too, not only for one investor. For example, one of the many pharmaceutical companies might take a dip, and many other companies in the same sector might be associated with its stocks. Hence, creating a problem for all. This increases the unpredictable nature of the stock market. Even though one particular firm might be doing everything right, their stocks may dip down due to someone else. Demographics. It really matters what kind of investors are playing in the field of stocks. According to Bill Schantz, the majority nowadays includes middle-aged people. Usually, this age group looks for long-term investments. The main reason is to gain financial stability. The more people invest, the greater the valuation multiple becomes, but the opposite happens when people start taking out their stocks, including people close to retiring. Pulling out on stocks decrease the valuation multiple. Because of this, the stock market becomes more vulnerable. Hence, it is important to associate in what place stocks are being bought, especially to reduce uncertainty. Bill Shantz's advice. A stock market is a volatile place. The majority of decisions are based on estimates, either estimates of how a trend might work or estimates of how well a stock might do. Regardless, none of that changes the fact that the market remains unpredictable. Because of this, many investors ultimately end up suffering losses. Though there is a way to avoid such disappointment, study trends carefully, especially if you are starting out. Stocks can be tricky, and many different factors lead to this, including demographics, inflation, market opinion, or even news portrayal. Therefore, one should always learn more to know the trends better. After all, that is what determines how a stock does, both in the present and the future. Thanks for watching.